Mm.
Guys, let's go ahead and begin. Uh, at 10:15, Tom Lewis is going to join us. But between now and then, I need to make sure that uh, I've got this text set up right so that we can see him the way we need to. So I'm going to play around for just a moment here while you guys are online with the view. So I think when I do this, that now we're looking at one person with a large image and the others are in the small images. Is that right?
Yeah, but we can.
Yeah.
Okay.
Yes, that's correct.
And the large image is switching from whomever is speaking to, back and forth, right?
Yeah, exactly.
Okay. So we're going to stay like this for Mr. Lewis's address. And during his address, he'll be sharing the screen with us as well. Excuse me. So, but I just want to make sure I had this set up properly. So while we're waiting for him, any questions that you might have with respect to the problem set that you're working on at the moment?
Yeah, I have one.
Good, because I know some of you do, and I was shocked at the silence. Okay.
So that's for the last one, for the Christian 10. Because I'm just like, I don't know, I did like what I thought, but I'm not sure that's good, and I just wanted to have your opinion on that.
Okay. So let me bring up the spreadsheet. I'm going to share my screen with you for a few moments.
Because yeah, in the solution, you don't have the Christian 10, I think, but you kind of think you're answering it in the 9.
Yeah, so I don't have, oh, okay. Well, what is question 10 then? I don't have question 10 in my solution set. Well, that must have been so that you couldn't rely on seeing my answers. You were forced to create your own. So remind me what question 10 is.
So that was finally with the valuation estimates prepared in 9. What might you recommend to your client with respect to a possible offer for Farm Hill?
Okay. Okay, so if I remember correctly, let me just look at this very quickly.
Because also in the Christian 9, you're talking about the valuation you made with the, like, on the client side with the client required return, and you're saying that the valuation is higher than the one from the company perspective, but it's kind of like, I don't know, for the KVD and the free cash flow, it's way lower, but for the FMM, it's higher. So I don't know, that's kind of...
Yeah. So here's what I wanted you to focus on with that. And if I err in my setup here, somebody tell me, no, Rick, you're not remembering this correctly, because I haven't looked at this element for some time. But if I recall correctly, you've gone through and you've done a valuation. You've done a full forecast without adjustments. You've done a valuation from the standpoint of the firm. And then you're requested to do another forecast with adjustments. And you're now doing this valuation effectively from the standpoint of the new owners. And it's those new owners or new investors that would bring these adjustments to bear, right? It is their relationships that we think can give us a increase in revenue, or it's their innovation and dynamics or markets. It's their relationships that and management prowess that we believe can give them a reduction in cost of goods sold and a reduction in sales and administration, and to bring our interest expense from a horrendous 16.36 down to, I think it was 6%. Well, obviously that creates a very different EBIT and creates a very different net income. So when we're looking at this, we come up with a whole different value. So we came up with a value, and I'll just focus on the free cash flow at the moment, of 79 here, whereas we had the 101 in the projection without adjustments, but at the firm's WACC. So in looking just at free cash flow, it would look like with those adjustments that the owners would bring to bear, the new owners would bring to bear, the firm has a lesser value. Does that make sense to us? Well, it doesn't make sense to me, because if we've increased EBIT by increasing revenue and decreasing expenses, I would think that it would have a much higher value, right? So, so immediately that doesn't make sense. So why is it that this shows a lesser value?
Because the R is almost double.
Exactly. Exactly. We're bringing to bear a completely different discount rate, and so that's changing the dynamic of this completely. What would happen if we took that R back to the R for the firm? So let's look at this. So I've got this, so without adjustments here, looking at the free cash flow at 101, and that's at a 5.52% discount rate. With adjustments at the same discount rate, we now move to 359. Well, I think that the discount rate that the new owners are expecting, or their required rate, was 12%, if I remember correctly, and that's what then yields the 79 value. But the reality is that these owners will be buying this company with its inherent discount rate. So that would bring us all the way to a valuation of 359. So Megan, you happen to be the CEO of Farm Hill, and you have to make the decision as to whether or not to recommend an offer to the board. And you know that the company that would like to buy you for 79 instead of 101. Are you likely to sell your company to them for 80 when you know that it's worth 101?
No.
No. In fact, isn't it most likely that you're going to expect not only the 101, but a premium from these people, because you know that if they integrate this company into their own portfolio of companies, they actually will be able to get more from it than you do.
Yeah.
Yeah, so you're going to be interested in getting a premium. So Jaden, you happen to be the director of the firm that's seeking to buy Megan's company. You know that you'd like to pay 80, but you know that they're not going to be willing to sell for 80. You know that they have a value that they can estimate at 101, but you also know that they realize that you're going to be able to get more out of their company because of the connections, etc. And so they're going to request a premium. Up to what dollar value might you be willing to spend?
Well, theoretically, you could say up to 348. I don't know. You might not be willing to go that high, but you could go fairly high.
Well, yeah. So you could go all the way to, you said 348. I'll say 359. And we're in the same ballpark here.
Oh, okay.
And if you did go all the way to 359, you would be spending a lot more than you wanted, but you know that you would reasonably expect to receive the company's opportunity cost of capital as your return. That may not be sufficient for you, but what you know is that you can pay a significant premium over the current valuation for McJames Enterprises and still end up very profitable. In fact, you could go ahead and pay a 50% premium, which is almost certainly not expected. I don't think Megan, even though Megan's pretty fierce, I'm not sure that she's quite that fierce to expect that kind of a premium. But you could pay 150, you could pay 200, and you still would have a substantial net present value. And when net present value is going to be that grossly positive, we know that internal rate of return will be substantially greater than the discount rate. So what I'm trying to get at with this, guys, is to help you think through the mechanisms as to why and how it is that companies in the open market that become subject to acquisitions most often will end up selling at a premium. Does that make sense?
Yeah.
Thank you for asking that. What other questions might you have with respect to this problem set? Okay.
So one question was just about asking like which valuation you should take, and I just suggested there that we have the FCF, KVD, and FMM, and I recall that you said once in class that what we could do is that if they're sort of close to each other, we can like take just the average of those three values and then sort of be like, hey, this is what we're willing to accept, because then you have like the three models average. So is that something to do, or is it just to go blindly with one of these models that you choose to go with?
Yeah, that's a really good question, Victor. You certainly wouldn't go blindly. And if you did decide that you wanted to focus in on simply one of the model evaluations, it would be because you have enough experience to know that that model form tends to provide the more accurate valuation for this kind of company. So whatever you're going to do, you're going to do on an informed basis. Moreover, I would say that valuation analysts would look at this two different ways. Some of them would look at this and say, well, we have in this case, and you can see my numbers here, a low of 97.5, let's say, or 97,500,000 on the KVD model, to a high of 115 million on the multiple-based model. Well, it seems to me that that might inform a range of acceptable values. So you're advising Megan in this, you work for the company, Jaden has come in with an offer that is within that range. And so I'm going to guess that you tell Megan to, at the very least, seriously consider it because it's within an acceptable range. So that might be one of the ways that you would look at this. So not averaging, but consider the high and low within these as a range of potentially acceptable values. If you're a valuation analyst and you're being given the responsibility to identify a particular value, let's say for tax purposes or for offering stock options or something of the like, you can't do that with a range, in which case you're likely to focus on a value, and you'll either hone in on one model because it fits that company best, or you will take an average of the three, or you might take a weighted average of the three based upon your experience and how these companies tend to price after they have been valued within these ranges.
So is there like, can we say already now that is there a model, for instance, where you would like to use FCF more than FMM? Is there like industries that you can say that, okay, so in tech industry we're using more FMM, and in like either like asset-based or equity-based businesses we use FCF, FMM, or something like that?
Yeah, we can, but the generalization is easy just to give a surface level of it, but it's hard to dive too deeply. And I will tell you that we dive more deeply into this in Finance 409. But as a kind of a common rule, very innovative, tech-driven companies, we're going to use a multiple. And early stage companies, we're going to use a revenue multiple because they don't have positive EBIT to be able to work off of. Mature companies that are heavily capital intensive with capital assets, airlines, rail trans, auto manufacturing, etc. We're probably going to use an adjusted present value model because they have such a high debt burden and they tend to have high interest expense. Remember, if we do that, we're not going to make the assumption that WACC and KU and K-tax are the same, though. We'll have more rigorously estimated those. For just your basic middle America mature firm, you're likely going to use a free cash flow model, and then juxtapose that to a market multiple of some kind.